Hi everyone, today's guest on Athletes Capital is from the world of hedge funds.
That's why I would ask them if they're asking like, "Whoa, how much should I put in that risky asset?" Well, I would ask them how much they're putting in non-risky assets.
We spoke with him about what are the risks in this asset class, what is the structure of a hedge fund.
Everyone understands risk only after they get burned, so just act like you've been burned.
And how an athlete can implement that asset class into his portfolio.
Calling something a hedge fund these days is like just calling someone an athlete. It doesn't tell you anything about the sport they're playing.
Don't forget to follow us on social media, subscribe to our YouTube channel, and enjoy the episode. Brian Anderson, welcome to Athletes Capital.
Well, thank you, Nikolai. It's great to be here. I'm really excited about this for many, many reasons.
Yes, and maybe people don't know, and I'm going to share it now. I appreciate your participation because you were one of the first backers of Athletes Capital and you actually embraced the idea from the beginning. I want to thank you first for that. And I know you have really interesting stories to share with our audience. And the most important thing is to bring value to the athletes.
Absolutely, absolutely. I mean, that's when you and I first connected. That was one of the common themes that we kind of shared with each other. Obviously, I have never achieved the level of athletic excellence that you have, but I was a soccer player or football player, as you like to call it over there, and it's very near and dear to me. I played throughout my childhood and grew up and played in college. And still follow it religiously. And as you and I had talked about in a little bit previously, it's right now we're in the hotbed of excitement here in the world of sports. We got the World Cup going on. The NBA, at this recording time, the NBA Finals had just completed here in New York, and NHL Finals are completed, and we have the U.S. Open in golf going. So things are exciting, and it's I love that you took this challenge upon yourself to help educate athletes, because we certainly appreciate them for their excellence, what they do in their sports, but it's, as I kind of mentioned to you before, it's our job here to make them dangerous in the world of finance and in their personal investments.
I'm going to use that as a title just to let you know that we want to make athletes dangerous in terms of finance. But it's actually true. And the more I do it, the more I talk about it, the more I love it. And let's start with the basics and tell our audience more about yourself, about what you do, and we will take the episode from there.
Sure. I won't get too deep into the stuff because most of it's boring. But I grew up in the United States here in the Northeast section, and was played sports growing up, a lot of different sports, but seemed to excel the most in soccer. And took that and my kind of how do I say it? I had also a propensity to be quite the hard worker, not only in soccer, but off the field and in jobs and pursuing career and academics. So I took that into the college level, played soccer, and uh, really tried to concentrate on the academic side, to the point where after college, I realized my professional career would not be in soccer. It would be better off in the world of business. And I was an accounting major, and took the accounting background and moved down to New York and worked on Wall Street for an investment bank. At that time, it was Bear Stearns, and um, started to really grow in the world of my knowledge of finance and the investment profession. I got my while going well, actually, while working full time, I got my MBA at NYU in finance, and then moved from an accounting role at an investment bank to more the money side of it and the investing side, and I got into the world of risk arbitrage. Um, and risk arbitrage is a strategy that basically is making bets, if for lack of a better word, on the outcomes of mergers and acquisitions. It's and I took that background and used that to move myself into the world of hedge funds. And through the world of hedge funds, I spent the next 20 years investing in not only risk arbitrage, but other event driven strategies like restructurings, mergers, spin offs, bankruptcies, and other corporate events, um, and even distressed investing in the world of credit. That ended in 2015 for me, in which time I went and bought using my own funds, I went and bought a manufacturing business and became an owner operator through what they call a search process in the world of ETA, or entrepreneurship through acquisition. Um, and then owned that business for 9 years and recently exited last year, and now looking for more businesses to buy, probably on a larger scale than my original manufacturing business. That was probably long-winded, but that sums up where I am today.
You mentioned the risk arbitrage, and I know you've been in the world of hedge funds, and that sounds like some. It sounds very mystic for a lot of athletes and a lot of people. Let's try to explain in very simple words what actually a hedge fund is, what its purpose is.
Yeah, I think it's a great way to go, first of all, because hedge funds are often discussed, but I think they're a lot of times misunderstood. Part of the problem is the word hedge fund itself. Um, the word hedge fund describes a structure more than the strategy, and this is kind of confusing. And it also doesn't really define exactly how the world of investing is. So I believe the term came back, it was like in the 1950s or so, and the person basically had bought some stocks and then sold some stocks at the same time, but not a different, it's called going long and shorting stocks, and did that at the same point, and that was effectively hedging the two positions were hedging each other. And so they called it a hedge fund, and then it's grown so much so that the definition, it doesn't no longer means what it originally was, because it now encompasses a lot of different strategies. But um, it's like calling something a hedge fund these days is like just calling someone an athlete. If I can make that connection here, it doesn't tell you anything about the um, the sport they're playing, the position they're playing, and so it's just really general, and it doesn't really describe everything about the person. Um, so let me explain what a hedge fund is. It's a private investment fund. It's where you have pooled capital from wealthy individuals and institutions, and that pooled capital is basically run or managed by a professional investment manager. Um, and with it, the world of hedge funds basically has a flexible investment strategy and toolkit available to them, more so than other strategies. And so, if I could go on a little bit more, I guess I could explain the private versus the public fund structure. That might help people understand it a little bit better. Okay. Okay. So like a public fund structure, and this is probably a great basis for most people to understand it, is that what do most people basically invest in? If they're not buying individual stocks, they can go and buy mutual funds, ETFs, and closed-end funds. That's a public fund structure. Like, who can invest in that? The general public. And it's one thing to know. It's heavily regulated. It means that um, the people that are running the fund have to do a lot of public reporting. They have to say what their positions are daily. It's just there's a lot of scrutiny of them, and the fees of them are usually very low. And investment flexibility is more restricted by rules and disclosure requirements. And it's generally a pretty transparent to the investor what they are. So if you're a mom and pop, you're going to go you're going to be able to invest in those no problem. You just can go and through any kind of investment advisor or investment structure, basically go and buy a mutual fund. A private fund structure is a little different. That's basically besides hedge funds, you have private equity, venture capital funds, and private credit funds. Um, so those are, to be an investor, who can invest with that is different. It's usually what they call an accredited or qualified investor. Uh, that means so it's usually a sophisticated capital partner. That means, as opposed to the general public that can invest in um, the public funds, which is protected consumers, and that's the individual retail investors, retirement savers, financial advisor clients, sometimes institutions. In a private fund, it's accredited or qualified investors they're considered sophisticated. So they're high net worth individuals, institutions, funds of funds, sovereign wealth funds. It means that they can take on risks. They are basically able to invest in more risky investments through the manager. The manager are able to invest in more risky investments because they're not essentially hiding anything or pulling the wool over their eyes of their investors. So it gives the manager a lot more flexibility, and it's also a lot more difficult to get into it. You have to have a certain amount of money to get into a private fund structure. In the world of hedge funds, to be accredited, I think you have to have at least, I'm guessing here, I think it's like, in my day it was maybe $500,000, or it might be $200,000 at least to invest in the fund. And many funds don't accept even that little amount. They want something that they want the check size to be at least $1 million. So it as a retail or a public investor, you can invest in just about anything. In this, you have to be consistent. As if you have more money, you can invest in. You have more options in the world of hedge funds.
There's always a correlation between risk and return in the world of
Yep.
investing. Would you say that in the public funds, actually the returns are lower than in the private ones? I mean, are investors compensated for the bigger risk that they're taking in the private funds, or are they taking a higher risk, in your opinion?
It's a great question. The answer, and I think there's a lot of empirical research that's looked at it over the years, and it's obviously changed over time. The the answer is, without getting too technical, the the world of hedge funds or private, we'll say hedge funds for this bit, they can take on what they call more risk of that's not systemic risk. It's basically they can go out there and find different ways to play an investment theme than just buying a stock and going long it. They have a lot of different um, and within a strategy they have a lot of different vehicles they can best invest in. The returns over time, originally hedge funds completely outperformed regular funds, but as they became bigger and they became more institutionalized, they have basically the returns of hedge funds has basically become more in line, but they still outperform regular public funds and fund structures, but they don't outperform like they did in the past. And the one thing that really separates the two is the fee structures. You pay a lot more fees to be a part of a hedge fund than you do a public fund. Um, and I don't know if we want to go too deep into the fee structure, but by paying more fees, you are reducing your return. So you better bet when choosing a hedge fund, and we can talk about this later. Among the many things you're looking at, obviously you're looking at the returns of the hedge fund. You're going to look at the relative risk versus it. But one of the big things in determining the success of it is the manager. and the fee structure, other things like the size of the fund, and then you want to see if it's the fit matches what your investment profile. So I do think that there's more talented people in the private fund structure, but the competition has grown, so they have to differentiate themselves by outperforming, and that's becoming harder and harder. So the world of public investment funds like ETFs, those those are lower risk because you're just buying the index, and you're not paying a lot of fees. Sometimes that could be a better alternative if you haven't done your homework. I would say I would not say that easily. I would say that it's if you are able to get into the world of hedge funds and you're able to do the homework needed, and you can find the right managers, and you've done a lot of research to find those people. I think you're better off putting money with them, but that's a difficult task, and you have to have a certain amount of capital to do it. Um, do I think you're foregoing any chance to make money? No, I think that if you can find yourself in the world of mutual funds or ETFs or closed-end funds, you're going to do just fine. So the one thing that we should talk about is hedge fund strategies, because remember I said it was really broad. And there's just so many different strategies in the world of hedge funds. You have to compare the public investment versus the hedge fund strategy investment as opposed to just the world of hedge funds.
Are hedge funds actually part of the alternative assets community, so to speak?
They're considered an alternative to that, because anything that's, I think, not a stock, bond, or cash is considered an alternative investment. I think you could put real estate in potential, in the stock, bonds, and cash as well, but anything that's really not in those four is considered an alternative.
And correct me if I'm wrong, but normally people are keen to put more money into the alternative asset investors because they're bringing better returns.
Yeah, I mean that is true, and there has been books written about that. It's just over time that as more money that goes into there, it becomes more difficult to basically to outperform. But you're absolutely right. The alternative investments are generally considered better, have been considered better investments, um, over the last 30 years. Um, but there's alternative, but to your point earlier that you should probably balance your alternative investments. You shouldn't have everything in commercial real estate. You shouldn't have everything in one type of hedge fund strategy. You shouldn't have it all in private equity. You should do a little bit of balancing your portfolio. And that's what I would say to any athlete, is that any athlete should basically look to balance their portfolio, as opposed to just playing one strategy like, oh, I'm just going to buy stocks. Um, that's dangerous, because stock markets do have big down cycles, and you would be better to have some kind of other asset class in your portfolios to basically cushion that downside.
Yeah, tell me about the risk assessment in hedge funds. And after that, we're going to talk a little bit about your private investments that you did, the company that you bought, and we're going to compare how you evaluated risk.
Well, I mean, let me just talk a little bit about the hedge fund strategy, because that's kind of important to understand it. Like, for example, when I was saying that the hedge funds, are generally subcategorized in their investment strategy. So when you just say hedge funds, it doesn't mean they have a bunch of different things like stocks in their portfolio or things. They generally, everyone, when you talk about a hedge fund, the next question is what kind of category they invest in. Some of those examples are long short equities, where you buy companies that are somewhat alike, and then you short companies that they dislike. there's global macro, and you've heard those are some of the bigger names out there. Those they make bets on interest rate, currencies, commodities, economies, and policies. I think those are some of the big names that you've heard at the beginning. There's event driven distress. That's what I was a fund part of, where you invest around mergers, restructurings, spin-offs, bankruptcies, other corporate events. There's credit ones that best invest just in credit, which is debt and other borrowing instruments. Um, what else is there? There's quantitative. You've heard about quantitative, maybe. Those are used big models, datas, and algorithms, and they do these computers do all this buying and selling of all different types of kind of assets. They could be buying, a currency, and they could be selling they could be selling a commodity. So those, and then there's different kinds of arbitrage. So there's just a lot of different strategies, and not one does them all. So when that's why I'm saying, like, when you talk about them, you should talk about like what category it is.
And if someone has to choose, what are the filters that he has to filter through? I mean, the risks and the pluses and the minuses if he wants to invest in an asset class like that, or a group of hedge funds that have different strategies.
Yeah, I mean so the pluses obviously is you're looking for better returns. And there in some things, some people say and you're doing it with less risk, because they're able to hedge, or basically they're using different instruments, or they're finding pockets where they feel like the risk reward is better, and they're able to exploit that better than you would be able in a public fund structure. So the returns are obviously what makes it. And but the risks, I mean, there are, it's like you have, the liquidity is not these are not as liquid as public fund structures, where you can maybe pull out your money from the fund quarterly. Some places are annually, some places are semi-annually, but or multi-year. Sometimes they lock it up for multi-years. So that means you don't have access to the money that you put in, or you can't like say, I don't want to do this anymore, let me pull it away. That you don't have that ability. The fees, as I said, on downside, are generally higher. So your returns that you get that outperform public fund structures must include the fees. So if you're outperforming, and then you put in the fees, and it's still less, the returns are generally less than what you would get in just buying an ETF. Well, you should just buy the ETF. So the outperformance has to be really notable. And some of these guys really can pull that off, or some of these, not guys, I mean some of these guys and gals can really pull this off. Another positive is the investment flexibility. They can use leverage, shorting. A lot of things they use are derivatives. They can concentrate positions, and they can invest in liquid assets. So there's just more opportunity there to basically generate returns if they find better risk return situations. But another downside to these is that they're not as transparent. You don't know sometimes what they're even investing in. They'll send out a quarterly letter and say, like, this is what we're doing, and this is some of our big positions, but and they don't have to report everything they do to the regulators. So that's the ins and outs. And the other negative is not open to everybody. You can't basically say, today I'm going to go and find myself a hedge fund, if you only have limited capital, or you don't have a way to basically reach out to them.
Would you agree that before an investor invests with hedge fund, as you mentioned, he has to see what the fees are and what the returns are, and compare that to what he can take, what is broadly available in the market as returns?
Perfectly said. Yep. You're going to look at the returns. You're going to, you can look at certain the risks. Like sometimes this company, this hedge fund continually makes money, or sometimes, one indicator of risk is it makes money, a lot of money, and then it loses a lot of money. And so they have to balance them out over time. And if you can't take that, that might be, that you can't take that risk profile, then you're not shouldn't invest in it. But you should compare that. You see the manager, how well they've done over time, and then you should do that, and you should just then compare it to like how the S&P 500 is the market is doing in the United States, or how some of the stock indices or bonds. If you're just like, if I just put my money in bonds, kind of safe investment, how much am I going to return there? So you're going to want to compare those and make sure that you are basically willing to put this money here, have it locked up, and that you're going to be paid to basically for their opportunity to run your money. So, but looking at the just the stock market, or the indices in each country is the best way to do it.
Let's talk a little bit more now about your investment in the private sector where you bought a company yourself. I had some athletes in recent months that actually got in contact with me and say, "Look, my career is over 2 years ago. I learned what I learned about business. I want to be an owner already." And I've heard that ownership is where all is at, and I want to own a company. Help me buy something, or explain me how to buy a company. So let's give some more context on people like that. I mean, is it a good idea? What they have to know, what they have to be prepared for in order to do that, to buy themselves a private company that either they have to operate or they're just going to be in the shoes of an investor.
Well, so you're actually having people actually come up there. Is it because of your background that they're asking this question, or is it just
I
think
think
that
so.
people just are just discussing it more?
I think so. Yeah, I think more and more people are starting to discuss it. But these particular two people actually asked me because of my background.
It is a different world. It's now one of the things I think that you can basically attest to, is, and I'll say it is that when you go out and buy a company on your own, or invest, or put yourself in as an owner operator of a company that you buy, um, you definitely have what they call active management of your investment, um, versus passive management. Like, what's passive management? And you can pretty much, I'll put that to both what we talked about in the world of hedge funds and in terms of mutual funds, ETFs. You're not really able to do much there. You're just basically investing your money with people here. But as with active management, this can be, it can be, the definition can have two definitions, but we'll talk about in this context is like, you are, if you're putting money to work and you're a part of the equation, that you can definitely have a say on the outcome, which is a nice thing, right? Because if you can see return, how things can change, and you can actually make those changes yourself, that's pretty rewarding. Um, but there is something to what you said that should be thrown with a little cautionary note. If you must want to be an operator, or must really think that you are an operator, to be an operator, you must just don't assume being an operator is something you're good at, or something that you will want, because that's a really big assumption, because um, it becomes very time consuming, and it's not everyone has the, I guess, the tools and the leadership that is necessary sometimes to be an operator. If you do, and or you are able to find people that are able to do that, and you can focus on other things, like working on the business, not actually in the business, being as opposed to being the operator. You could be one of this person that provides a strategy. It is incredibly potentially rewarding, from a personal standpoint. Like, you might find those days just absolutely incredible, because you can actually see tangible results. Um, from a risk return perspective, that is also, something that I think people should basically consider this business, this industry out, because um, the returns can be pretty darn good. especially if you go in there with a thesis of that you can grow this company or improve this company. Um, and the risks, if you're buying a profitable business and you've researched it enough and there's no real surprises to be had there, they're pretty limited. You have something with a lot of return on the upside potentially, and risks that the downside might be somewhat limited if you've done your homework, and your due diligence correctly. So my advice to those people would be to say, search, make sure that they're that person that would be an operator, and then yeah, go out, reach out to people like yourself, and me and others. There's so many of us out there, and have those conversations to see if this is what you really want to do, and if you are, go for it.
What about the team around you? Because as you mentioned, buying stocks and bonds and investing in the public markets, you don't need a team around you. You need the good research. But
Right.
buying a private company, you actually are the one that has to run it, or have
Yeah,
someone to run it. So
yeah.
what about the team?
I mean, that's it couldn't be more of a great theme there here in Athletes Capital, right? I mean, yeah, I don't care if I don't if you're doing an individual sport that's considered an individual sport like golf, or maybe tennis and everything. There's still a team around you. And then even if you're in a team environment, there's even more teams. So I think the analogy is perfect for those people, is that if you're going out there and buying something, and you have not basically weighed what the parts of the team are, or how there's if you're going to be running the team and you're going to be doing everything for the team, then you can expect not great things. So you have to be 100% confident in your team or your ability to build a team, because there's going to be situations where it just is missing a couple pieces, but you can go out there if you're the right minded person with the right leadership or understanding of the business. You can build that team. So team is everything. Don't I mean I, Finding the good idea is the first thing. Like, what's a great business? If you find something great, just make sure you have the team to basically make that something great even greater. And But I think it's everything. I that's and The word I use is talent. Does it have talent? And it doesn't have to be necessarily the person is, you know, one of the best in the business or one of the best athletes out there in their sport. But do they have the talent where it's needed, and can it be can the talent of one person complement the weaknesses of another person, and vice versa. So it's I think any athlete that basically looks at this will have not much difficulty with that, because they'll understand strengths and weaknesses and the team concept.
Yeah, athletes definitely understand what what a team means, what a good team means.
In your experience, doesn't that translate somewhat true? I mean, to business as well.
Oh yeah, I mean athletes actually develop a lot of qualities that can serve them pretty well in the business world, and I think they are very well equipped to do good in the business world and in the so-called real world. But I will ask you a particular question, a concrete question about that a little bit later. Now I want to ask you something different, which relates again to the athletes world, because athletes, most of them in most of the sports, they earn more than the average person, but that makes them rich. I want to ask you, what is the difference between rich and wealthy?
Yeah, obviously that's it's a great barroom question, because you if I think everyone in the bar will have a different, or pub question, because everyone will have a different answer. But I think that they are different. I do. It's funny. I think it was even brought up in the movie Wall Street, where Michael Douglas, well, Gordon Gekko was basically saying, he goes, that's rich, but real wealth is different. I think being rich is having money that's comfortable, where you basically are able to enjoy a lifestyle um, that you are content with, and or and it allows you to basically um, not worry about monetary money things as much. um, being wealthy is it's almost generational. It's like that you are not only are you well what you are wealthy, you are rich, but the people around you and the others that you are basically going to be working. I mean, your family and things are also well off, and you don't have to worry about things. It's it's be creating wealth is when you create wealth, you are putting yourself in a position and others in a position to basically enjoy the benefits of your labors um, in this generation and next. I think that's how I look at the two differently. It's that you don't even think about the price of something when you basically when you go and look at it, and that's a little obnoxious to say it, but you get what I'm saying though, right?
Your perspective is interesting around that. I think my opinion is that actually wealth is more about time. You're owning your time because you don't need to continue to do what you're doing to earn your money. But basically, you have your own assets that are actually bringing you cash flow, or they're working for you, and you don't need to continue to do what you're doing. While being an athlete, it doesn't matter how well paid you are. You should continue to have your career and go on training camps and play games in order to be paid. So that makes you
Yeah.
rich, above average for sure, but it doesn't make you wealthy because you cannot stop.
I mean, that's a probably a better definition. I think that's exactly spot on. I mean, the difference, yeah, the which comes to one of the core elements of how do you become wealthy, and maybe we can talk about that at some when we think about that. But there is I think one tenet to becoming to making it taking a person, and every athlete should subscribe to it at a young age, and what the difference is between being rich and wealthy is.
You mentioned the magic word compounding, and I love it because, I mean, in the investment world, it's used a lot from many smart investors. Uh, Many of them, like Warren Buffett and Bill Ackman. What do you think about compounding? Let's talk a little bit more about that.
I mean, I honestly think that's the difference between being rich and wealthy, and that's to your point is everything is that if you're an athlete and you're making good money at this point and you're younger in your career, how do you get wealthy is that you take excess income and you make it work for you from this point going forward. And so the each dollar you earn basically then grows upon another dollar, and so you are the money starts to just grow basically just instead of just growing linearly, it starts to grow um, in a logarithmic way, and it's so it you start to the curve steepens the growth, and as the years as time moves on the curve steepens more and more and your money starts going up and up and up and up, and you're not doing anything. And the reason why is you've put that money to work for you as you described. That is a layman's version of the compounding effect. It is, and it is amazingly powerful. And the problem with the compounding effect is it's really difficult to see in the short term, and it's really difficult to see when you're young and making the money. But if you do it properly, your later years are going to be the most comfortable years of your life. You're always going to look upon your days like you and I probably do already of when you were playing the sport, but it's you can at least sit back and relax and enjoy the fact that your hard work has basically has given you monetarily, and it's just it's such that everyone, but Warren Buffett basically did it. There's so many of the great people have done it. There are a couple of basically grown wealth overnight, but um, you can't teach growing wealth overnight. You can teach compounding effect. Um, anyone that gets rich over 20 years is not going to be celebrated, but boy oh boy, it is powerful, and they could be just as rich, if not more.
I appreciate what you're saying because one of the components of the compounding effect is time. And actually athletes have the opportunity to start investing earlier in their life in order for the compounding effect to grow big basically in the future. And the earlier you start, the better, because you give it the opportunity to work in your favor.
Yeah, they have an advantage that the rest of the world doesn't. Their money is skewed to their earlier years, so they can grow wealth much greater than others as long as they do it properly.
Yeah. And just for our audience, a very interesting fact that I heard recently from Bill Ackman. He said that I'm not sure, do you know, but right now he's trying to make Berkshire Hathaway 2.1 with his Howard Hughes corporation. He wants to do the same vehicle as Berkshire. And he said when he checked what was the net worth of Warren Buffett at 50 years old, it was like 400 million at 50, which means that, and now he's like in the hundreds of billions, and he gave almost half of it away. But that means that the compounding effect actually kicked in Warren Buffett's life after his 50s, which is how the compounding magic actually works.
Right, right, right. I think it was in Warren Buffett's biography that he talked about, like he had mentioned at one point what he was going to say, like, was enough. He's like, oh, I'm going to want to be a millionaire by age 30 or something to that effect, and that'll be enough. Um, and I don't know if he was using it that he was going to walk away, but I think he was saying, well, if you get a million by age 30, then if you continue to compound it and do other things wisely, you're going to be in great shape.
I think the second one is the case. He wanted to compound that amount for as long as possible, and actually he's still doing it, right, on 90 years old. Okay, you mentioned about something interesting, and it's a very interesting dynamic how athletes are actually earning their money. And I want to talk a little bit more about that now. We want to connect everything what we said now with you with the athletes world. So an average person is earning his wealth through 10, 20, 30, 40 years through their career when they start working. And if they do a good job investing, they grow their wealth through these 40, 50 years. But actually with the athletes, this thing is the opposite. This dynamic is the opposite. And what I mean by that is from a very early age, something that we said with you now, they received a huge contract in front of them, and they don't know how to manage the assets that are put in front of them, which a lot of people think that that's a good thing to have so much money at that early age. But I think it's a burden, because the athletes, it's more of a burden than a good thing, because the athletes first of all should be focused 100% on their craft, because they have to be better and continue improve their skills in the sport. But at the same time they have to think for their financial future as well. And that's a huge dichotomy in that situation. In your opinion, what an athlete, and I think we mentioned a couple of things here, but what an athlete in that situation should do in order to take care of his finances and the assets that he just received?
I mean, the first thing I would say that they could do individually, personally, is live within not live outside their means, but live within their means. They basically should, while they are getting a lot of money right now, they should basically say, okay, well, I don't really want to blow a lot of money right now. I think that's the thing, and that what I'm saying there is, it's not to live a life of a pauper and be really a miser with your money. What I'm saying is live life comfortably, live life enjoyably, do things that you weren't able to do before, but don't overindulge, because at that point you should be basically just taking as much money as you can that you would deem to be excess income. Excess income is income that you don't need, that when all your expenses are your reasonable expenses are basically put against your income, what's left over. That money should be invested. Now, I understand that certain things you might want to take care of a family member, or you want to do something to that effect, and those things should go into your expense category. Um, but the first thing they should do is take as much money they can and just start thinking about how to invest it, which brings up the problem with the second is how to invest it. And that's where your point is a really good one. I mean, they're obviously focused on their craft. How much are they going to be able to sit down and do all this with the markets, um, or look at different investment themes? And that is somewhat true. That is somewhat true. But I think you can start off early there with a sound financial planner, a person that basically has done this for many athletes, a person that is reputable, a person that is not a family member or is someone that basically just it just shows a lot of admiration for them, and but they don't really know much about the person. You just want to make sure you find someone reputable that's can put it in. Just you could use public funds at that point. You could do it in mutual funds, ETFs, closed end, but make sure the money starts working for you. And as you start to and watch your investments, okay, that's the other thing. Watch and try to understand, learn them and everything, because that's going to help you then be able to become more sophisticated in your understanding of the investment world. And as you learn more of the investment world, that's where you start to step up and basically, well, I need to, if I could look at other investments, who do I go into to speak to in regards to this to understand a little bit more, or find another person that's a little bit more that that's not just comfortable running public funds, or mutual funds, that people that would look into alternative investments for you. But make sure that person is trustworthy, or make sure you have a trust there, or there's a track record, or there is something, because you hear all kinds of stories of people of a person that's handling their exclusive client and taking advantage of their exclusive client. But talk around and make sure that money starts working for you earlier, and then pay attention, read a little bit, understand a little bit, and listen to this podcast over and over and over again, right? Um, and then you step up the spectrum in terms of how you invest it, because then you can as you get more sophisticated, you can do more, and there'll be it's actually a great world because it's filled with really, really smart people. There's so many people to talk to. It's filled with lots of information, lots of misinformation, but lots of good information, and it's fun to follow. So it's you can track it in the newspapers, and it's like following a team, and you're making bets. It's great. So participate, be a part of it, make sure your money, you understand what your money is doing, but you're watching it and learning more as you go along, and you do those simple things, and you don't take you understand you we have to talk about risk at some point, but if you do a good job with the risk management, that compounding effect is, you have to do nothing more for that in compounding effect. You will by age 50 be sitting on a fortune.
A couple of interesting things that I want to discuss now with you. One of it is risk. During my career, and I said that in a couple of other episodes, I said that one of the easiest people to take their money out of their pocket are the football players. Almost on a monthly basis, we had opportunities put in front of us, like venture type investments, which are, one of it is going to cure cancer and the other one is going to space, and all the charts are showing everything is going straight up, and we get excited. We got excited, right? And some put 50,000, other one put 20,000. I mean, I have a lot of examples, but
Yep.
Imagine yourself, you're that kind of an athlete. It doesn't matter in soccer or in whatever sport. What would be the filters, having the knowledge that you have now? What would be the filters that you're gonna filter that through that investment?
Well, I think my first filter is the one that is probably the best filter. It's the sniff test. If something sounds too good, or it's like promised like this is an amazing opportunity. Oh, and everything you're gonna rake it in right away. You should run for the exits. No way. If it's too good, if it sounds too good, or it doesn't, it's everything about it is rosy. You 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 have to approach that with a huge amount of caution. There is the world of finance. There's just very few that get rich off of something real easily. For example, right now we could talk about AI. It's everyone's buzz, and everyone's talking about buying these companies and some of these AI companies. And um, okay, I can promise you that a bunch of these, if you buy them right now and hold on to them, you are going to lose a lot of money. Now, you're going to make a lot of money too. So I'm not here. I'm not saying to pick. You're going to be able to pick the winners easily. Um, it's just it's just too easy. Making money isn't that easy, and that it shouldn't happen overnight. That's what if anyone's promised you overnight riches or really quick money to be made, it just and it doesn't. That's where I'm saying it doesn't pass the sniff test. It just seems like, well, it's too good to be true, or what am I missing here? When you hear it, trust that instinct and go against don't go against your what your I guess your subconscious is telling you. Does that make sense? I mean, there's just no it's everything over time. You never weigh what you're making in the short term.
I have a couple of athletes that are actually asked me here again in the past couple of months. They asked me, okay, but if I want to do some more risky investments, what would you recommend? And to that type of person or to that type of question, what would you say?
I would say, well, I would ask him, what are you doing that's not risky?
To that type of question, I can tell you, I can share you what I said is that because I understand them. I understand them that for when you're young and you have assets, obviously you have to think about them, you have to preserve and grow them, but you always want to have some part of it that are allocated to this venture type of investments, which most of them won't work.
Right.
But would you agree that it's a good idea to, or a good way to go, to have certain percentage of the assets that you're investing and the smallest one, but to be invested in a risky type of assets like this,
Yeah.
what we described?
I would definitely do it. That's why I would ask them if they're asking like, well, how much should I put in that risky asset? Well, I would ask them how much they're putting in non-risky assets, because, or what are they basically not putting? That's not what are they not risking a lot of money in their investing world? Because you don't start off with risky investments. You complement a portfolio with well chosen risk choices. So I would when anyone approaches me with a risky idea and it seems like it's risky, some of them could be really good. Just make sure it's it's not a big bet. It's not You're not pushing all your chips to the table. You're taking a little stack of chips and saying like, okay, I'm going to put that over here and that one risky bet, but I'm going to put this over here on this safe little where it's just all this money is just compounding differently, or I have these in different, and you can don't divvy out your investments. But and if you're thinking about putting something in a risky bit, make sure it's basically offset by less risky investments.
Prepare the nest first, and then you can allocate some small percentage from your investing assets into the risky portion.
And as you get a feel for investments over time, you might know how much to invest. You'll be a little bit better allocator. Like, I could put a little extra more on this because I think this is a really good idea. And the whole idea of understanding risk, unfortunately, is being burned. Don't you think? I mean, that's what there's no better. Everyone understands risk only after they get burned. So just act like you've been burned.
Yeah, unfortunately, until you've been burned, you cannot act like it.
Yeah, it's yeah, it's tough. It's tough, but we all have those little moments, and you look back on me, you're like, what was I thinking? Um, and but if it's a small little bit there, and I can remember one where in my early career, and I was like, well, yeah, I'm glad I learned that lesson then.
And it was not that expensive.
It was not that expensive, but it was a stupid one. Let me tell you.
So when you're an athlete, you're required to develop a lot of human qualities that, in my opinion, can serve you very well into the investment world. And right now, you have a lot of experience in hedge funds and into the private assets investment. Would you say that qualities that athletes are developing, like willpower, tenacity, focus, can be very helpful in the investment world? We also mentioned teams, and creating a team around you.
100%. I think if you basically were able to rake through the world of investment worlds, whether it's people on podcasts like these, or other podcasts, or just in general, you're going to see a disproportionate number of athletes from the past. Why? Because just exactly what you talked about. It's the perseverance. It's these people. They basically they do understand risk better than most, because they understand risk in a game perspective. They just now have to apply it better. They have to take that understanding of risk in one scenario and apply it to another. And and when you understand risk and return, that can be applied differently. So that's one thing that's an individual thing. The other thing is the idea of working with a team, as you brought up. Those things are invaluable, and those don't come easily. Like, I mean, you know, I'm sure in your playing days, and I'll ask you, but like you probably were accused, or you accused other people of being a ball hog. Where is that a term that you're familiar with? Yeah, so I mean, and that was like, you were showing distrust or dislike of what another teammate was doing or something, and or pass the ball, or don't be so selfish, or sometimes you're telling players to be more selfish, take the shot, or and um, so those concepts are those they feed you, the subconscious, and they just become a little part of you that allows you to do things better and communicate better in the real world. I mean, it's very similar to what you see sometimes in the military. Some of those things translate very wonderfully. The idea of following directions, and having a operating procedures, or team, or game plans, and then operating under those are powerful. But the beauty is, and I guess I'll make another reference. Like, it's like the Karate Kid, the movie Karate Kid. Mr. Miyagi's teaching him all these things, and you don't know you're realizing you're getting them until then you have them in life, and you're like, wow, I got to apply them. So yeah, athletes are better equipped than the average, for the world of business and investing, and they should know that. And that's why I think, to your point, get started early, because your skills are already there. Just utilize them in a different way.
One final question from this section, Brian, will be: you mentioned financial advisors and wealth managers. If you're a professional athlete and you want someone to look after your assets, how would you filter who you will work with?
I guess one thing is like, I guess, let's compare it to the media. That you know Originally, um, athletes basically want to be in the media. They want to have the spotlight on them and everything. And then, if let's say they become very successful, then their perspective changes. Like, well, is the media really my friend? It's not portraying me correctly and everything. Like, do I really trust them? And then, if you break it down, you can find certain people in the media that you find more trustworthy than other people, because you've developed them. You have to develop a relationship with them. I think this is where the world of meaningful relationships comes into play. Is that you have to develop in meaningful relationships with people that are basically going to have access to your money, and you can do that through um, people that you currently know, you asking advice, taking, you know, looking where others have found success, and then talking to them. But you have to put yourself out there. You can't implicitly trust others with your money. It just, you can't. You have to make sure. I think every athlete has this responsibility to, and they have enough time to do this, to make sure those that you're investing your money with are are trustworthy. And then, and if you don't trust them completely, well, don't allocate all your money to them. Find another person, or give them a portion. Let them run a trial run, and then make sure. We talked about transparency with private funds versus public funds earlier. That's a big thing. You need everything that goes on with your financial information, or your investments, and the way you're putting in. You need to have complete transparency of what's going on from those people that you've entrusted your money to, especially at first, especially when you are developing in this world. So sometimes transparency is really easy. You can find a brokerage account that you can look on online, and how your investments are doing daily, because you've bought a couple mutual funds. But talk to the right people. Financial advisors there's some really good ones out there. There's some really not so good ones out there. But you'll get a feel for it when you listen to other people that have developed what they call meaningful relationships with those people. But make sure that it's, you understand that person and you're comfortable with that person. What do you think there, Nikolai? I don't know. I I always I fortunately felt like I had a good feel for that, and I didn't feel like I was ever going to be taken. I did enter business right after school, but do you think that, how do you get around the vulnerability, do you think?
Trust is a big part of it. And I think at some stage athletes are a bit naive with their money because they come so easily so early. And I mean, when you say easily, obviously they put a lot of sweat and tears into them, but they didn't they didn't have the experience in investing money and losing money and filtering investment opportunities so often. So that's why they need, as you said, they need to start earlier, maybe get burned a couple of times, but for sure they don't need to put all of their eggs with one investment, one wealth manager or one investment advisor or whoever is managing their money. They should not put in the beginning all of their assets with one guy, for sure.
The one thing that I can say that athletes have is that they know, they I, through they should treat that person like a teammate. Do they trust that teammate, or do they not trust that teammate? Is this like a person, like, would I give this person my money? Or if they're ever making a decision like, well, I'll just let them run it and everything like that, that's just never to make that decision. Money is like a child. They should treat it like a child. And that sounds a little cheesy, and that sounds a little selfish and a little, kind of money, but like, don't you shouldn't trust anybody implicitly.
Before we wrap this up, Brian, I would like to ask you, what are your recommendations about books that athletes can read?
In regards to the compounding effect, there's a book called The Slight Edge. I know Slight Edge. Here, I'll show it to you. Let me hold on. Let me see if I can get it. This is one. You see it? Jeff Olson. That is one book that it talks about the compounding effect in a simple, easy way. There's other books out there, but I think that's a good one. And I know certain coaches have used that for. I know there's a college football coach, American football coach here, that gives this book out to some of his players when they get in the program, and it basically talks about certain things about the compounding effect that can help with them as a team, building up and forward. And it also talks a lot about that and the money. So I think that's a powerful book for an athlete, because I guess if coaches are giving it to them, it should work, right?
Yes, yes, and I will buy it as well.
That's a really good book. There's some leadership books, but I think those are a little bit more on the leadership side.
Well, okay, Brian, let's wrap this up. I want to thank you for your participation, for the conversation that you put in the time, and I really hope that we're gonna be able to make athletes dangerous with their finance.
Yeah, I agree. I agree. Athletes are dangerous already. Let's use it for their money making.
Yes, yes. As we said, they're very well equipped. So hopefully, we managed to provide some value with that conversation to them.
All right. Well, excellent. This is great. I love this who we're reaching out to here. And I want to make myself as accessible as possible to if anyone ever wants to talk about this topic.